Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at BigBear.ai.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock.
Yeah.
If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
Imagine looking at a company that is just, buried so deeply in debt that Wall Street effectively left it for dead.
Yeah, completely written off.
Right. A company that most people viewed as just another sluggish, debt-burdened defense contractor. But then, almost entirely under the radar, they quietly rip up their IOUs. They amass nearly $500 million in cash, and they embed themselves into the most highly classified military networks in the country.
It's pretty wild.
It is. So today, for you listening, we are analyzing this massive structural transformation.
Yeah.
We're looking at a company trying to shed all that legacy financial baggage so they can emerge as a cash-rich, high-margin, specialized artificial intelligence platform.
It truly is a complete metamorphosis. And I think the sheer scale of this transformation is what makes it so incredibly compelling right now.
Right.
We are talking about a massive pivot here.
Yeah.
They are actively shedding that old legacy defense identity and moving aggressively into highly classified AI infrastructure. For investors who are willing to look past the old headlines and pay attention to the mechanics underneath the hood, this is creating what looks like a very rare ground floor opportunity.
I definitely hear that enthusiasm. But as always, we had to temper that excitement with a very healthy dose of reality.
Fair enough.
Because anyone who's been investing for a while knows that, turnaround stories can often just be value traps. Transitioning a massive business model is never a smooth ride.
No, definitely not.
It comes with extreme turbulence. You don't just snap your fingers and flip a switch from being a clunky defense contractor to a sleek, high-margin software platform without experiencing growing pains, operational friction, and serious stock volatility along the way.
That's entirely true.
So the core question we need to unpack today for you is whether this pivot is actually sustainable or if it's just a temporary mirage.
That is exactly the right question to ask. And to figure out if it is sustainable, we really have to look directly at the foundation they're building and, more importantly, who they are building it for.
All right, let's move into the wealth building context.
Great.
If we are going to understand how a stock like this fits into your long-term portfolio, we have to view it as a direct play on national security and classified AI integration.
Yes, absolutely.
We're living in a world where governments are just absolutely rushing to modernize their technology. But the catch is they operate in highly regulated, completely locked down, secure environments.
Right. It's not like the private sector at all.
Exactly. We're talking about national security, secure global trade, complex travel logistics. You can't just take an off-the-shelf commercial AI chatbot and plug it into a classified military network. It just doesn't work that way.
No, the compliance hurdles are astronomically high. You're dealing with data that, if it gets leaked, poses a literal threat to national security. So the barrier to entry for any tech company trying to sell AI to the government is massive.
Right. But that barrier to entry actually brings up my biggest concern: the reliance on government contracts.
I know where you're going with this.
Yeah, anyone who has ever been to the DMV knows the government does not do fast. Now imagine that DMV-level bureaucracy, but applied to cutting-edge, classified military artificial intelligence.
It's a nightmare.
It is. You are dealing with endless background checks, congressional budget debates, continuing resolutions that threaten to shut down the government, and just mountains of red tape. As an investor trying to build wealth, depending on that slow-moving federal bureaucracy for your company's growth is a really tough pill to swallow.
It is agonizingly slow to get in, I will grant you that completely. But, you have to think about the economic moat that it creates once you are finally on the inside.
Okay, lay it out for me.
Let's use an analogy. Imagine you're hired to install the plumbing in a high-security military fortress. Getting the background checks for your workers, clearing the contractors, getting the blueprints approved by 10 different generals, it takes forever.
Oh, absolutely forever.
Right. But once you're finally inside and you've laid your pipes behind 3 feet of reinforced concrete, they are practically never going to rip those pipes out. The cost and the headache of switching to a new plumber are just too immense.
The plumbing in a fortress. That is a fantastic way to visualize the switching costs in government tech. Once the concrete is poured, you're entrenched.
Precisely. And that is exactly what BigBear.ai did when they recently acquired a company called Ask Sage. With that one single acquisition, they instantly onboarded over 100,000 users. Yeah, across 16,000 different government teams. So while much larger enterprise software players, names you hear all the time like Palantir or C3.ai, are standing outside the fortress trying to pitch their new pipes, they actually struggled to displace BigBear.ai in these very specialized classified deployments.
Because they're already inside.
Exactly, because
Yeah.
this company is already entrenched behind the fortress walls.
Now let's look at the fundamentals. Because having a great moat and being inside the fortress is a great narrative, but, well, a narrative doesn't pay the bills.
Sure.
If we're going to trust this turnaround, the bank account actually has to match the blueprint. And right now, financially, they're walking a serious tightrope.
They really are.
They're trying to manage a transition in their overall top-line revenue while simultaneously trying to expand their bottom-line profit margins. And if we look at the first quarter of 2026, their total revenue came in at $34.4 million. That's actually down 1% year over year.
Which I know looks bad on the surface. I mean, a growth tech company shrinking its revenue is usually a massive red flag.
Exactly, it makes you pause.
Right, but we have to explain why it was down. That slight 1% dip was entirely due to lower volume on their legacy old-school Army programs.
Oh.
However, that decline was almost entirely offset by the new revenue stepping in from that Ask Sage acquisition we just talked about. So what you're actually seeing is lower quality, low margin legacy revenue rolling off the books and high quality modern AI software revenue stepping in to replace it.
And you can see that quality shift directly in their profit margins, which brings us to probably the most striking data point of the entire quarter. Their gross margins skyrocketed an incredible 1,278 basis points year over year.
It's just a staggering number.
It really is. They jumped from 21.3% in Q1 of 2025 to 34% in Q1 of 2026. For anyone listening who doesn't speak fluent Wall Street jargon, let's translate that. In plain English, their profit margin on what they sell jumped almost 13% in a single year.
Yeah.
That's like a local grocery store suddenly keeping 13 extra cents of pure profit on every single dollar they make.
That is the exact bullish inflection point we're looking for. An almost 13% jump in gross margin in a single year is a massive fundamental shift. And that is directly thanks to the generative AI products they brought in from Ask Sage.
It validates the acquisition.
Completely. That is the hard mathematical proof that the transition from a low-margin defense contractor to a high-margin tech platform is actively working.
But the bottom line still looks incredibly muddy if you're just glancing at the headlines without digging into the accounting. They reported a GAAP net loss of $56.8 million.
Ouch.
Yeah. If I am an everyday investor, seeing a $56 million loss makes me want to close my brokerage app immediately.
I completely understand that reaction, but we have to explain how that loss is calculated. That GAAP loss was heavily impacted by non-cash debt extinguishment and derivative mark-to-market issues.
So it's essentially an accounting penalty.
Exactly. It's an accounting penalty for cleaning up the house. It's paper losses, not actual cash flying out the window. If you look at their adjusted earnings per share, which strips out all that non-cash accounting noise and just looks at the core business, they actually beat Wall Street analyst expectations.
Oh, really?
Yeah, they came in at a loss of 4 cents per share versus the consensus estimate of an 8-cent loss. Furthermore, management stood their ground and affirmed their full-year revenue guidance of $135 million to $165 million.
We also have to talk about the balance sheet because there has been a total deleveraging here, and we need to explain how they did it.
This is my favorite part.
It's clever. They settled $124.6 million of their 2029 convertible notes entirely through what are called debt-to-equity conversions.
Right.
Simply put, they went to the people they owed money to and said, instead of us paying you back in cash that we don't have, how about we give you newly printed shares of our company?
It's a bold move.
It wipes the debt completely clean, though it obviously dilutes the ownership pool for existing shareholders. But the result is undeniable. Now, there is only $16.5 million in debt remaining on their entire books.
Which is practically nothing for a company this size.
Right. That saves them almost $5 million in interest payments alone compared to last year.
And clearing that debt leaves them with an absolutely incredible cash war chest. As of the end of Q1, they are sitting on $431.5 million in available cash and investments.
I have to play the skeptic here, though.
Of course you do.
My eye is twitching looking at their cash flow. You mentioned the huge cash pile, but their operating cash flow for the quarter was a negative $18 million. They are still actively burning cash just to keep the lights on and operate the business.
Yes, that's true.
Burning $18 million in 3 months is a heavy, heavy deficit to run quarter after quarter.
It is a deficit, yes, but context is everything here. When you have a cash pile of over $430 million, an $18 million quarterly burn rate is highly manageable.
You think so?
Absolutely. That massive liquidity provides them with a multi-year runway. It means they can fully fund their research and development, pay their engineers, and even pursue more strategic mergers and acquisitions. And they can do all of that entirely without the immediate, terrifying fears of solvency or emergency survival dilution that used to plague this company just a year ago.
That brings us to the catalyst timeline. Having a multi-year runway is great for management's peace of mind. But as an investor, you want to know what is actually going to drive the stock in the next 3 to 6 months.
Right, you want to see the catalysts.
Obviously, the big immediate hurdle is the Q2 2026 earnings report coming up in August. Investors are going to be hyper-focused on tracking that $135 to $165 million full-year guidance to see if this Ask Sage momentum is actually holding up.
We also have their annual general meeting on June 9th. They're launching a new retail voting program, which is a very smart corporate move.
How so?
Well, it's designed to boost shareholder engagement and keep retail investors loyal and feeling like they really have a voice in this turnaround. But honestly, the real macro tailwinds, the massive industry shifts, are shaping up for the second half of 2026.
You're talking about the unlocking of delayed federal contracts.
Exactly. The passage of the massive U.S. defense budget, what people in the industry are calling the One Big Beautiful Bill, is a critical catalyst.
Yeah, that's a huge deal.
It is. You combine that macro budget approval, unlocking billions in federal spending, with some of their recent specific wins. For example, they just landed a major $53 million sole source classified award.
And we should explain what sole source means for you listening, because that is vital. It means the government didn't even put the contract out for competitive bidding. They didn't invite Palantir or anyone else to pitch. They looked at the highly classified requirements, decided BigBear.ai was the only company technically capable of executing it securely, and just handed them the $53 million contract.
Exactly.
Plus, alongside that military win, they're aggressively expanding the footprint of their BearScan and TrueFace technologies in commercial airport deployments.
That $53 million classified award is huge proof of concept.
It is, but I have to push back on the timing. If we are relying heavily on these macro government budget unlocks actually hitting the balance sheet in the second half of 2026, what happens if federal delays persist?
Wow.
We just talked about the DMV-level bureaucracy. Could these expected revenues just get pushed completely out into 2027, leaving investors holding the bag for another year?
It is a totally valid risk, and it is exactly why investing in defense tech requires patience. Government timelines are notorious for slipping to the right.
Yeah, constantly.
But the budget is legally passed now. The capital is officially allocated by Congress. So it is no longer a question of if the money will be spent on these AI upgrades, but exactly which month the federal checks will finally clear.
Now let's pivot to the chart. While we wait for those federal checks to clear, the market is already placing its bets.
Oh, definitely.
Looking at the technical structure of the stock, we're seeing a violent tug of war between high volatility and smart money accumulation. The stock is currently trading right around the $4 mark.
Right.
That puts it above its 50-day moving average of $3.75, which acts as a short-term floor of support. But it is still facing heavy technical resistance below its 200-day moving average, which sits up around $5.13 to $5.16. That is acting as a heavy ceiling right now.
The price structure is genuinely fascinating to watch. I mean, the stock is clearly basing, trying to find its ultimate bottom. It had a terribly steep drop from its 52-week high of $9.39.
That was a painful drop for a lot of people.
Very painful. But remember, that drop was largely due to the mechanical dilution from converting all that old debt into new equity shares. Now that the debt overhang is finally cleared out of the way, it has established a very firm floor. Every technical trader is watching for a psychological breakout above that $5 to $5.50 range.
But the momentum is absolutely wild. We are looking at an elevated beta of 3.25.
Which is high.
Very high. For you listening, a beta that high means this stock is a roller coaster. It reacts more than 3 times as violently as the broader market. If the overall market drops 1%, this stock might plunge over 3%. If the market rallies, it rockets up.
Exactly.
And we saw that exact violent reaction right before their last earnings report. The stock surged 8 to 10% on massive volume. We're talking 50 to 70 million shares traded in a single session compared to their normal daily average of 37 to 39 million.
And then, of course, it slipped right back down post-earnings when retail investors panicked over that $18 million cash burn number we discussed.
Right.
But if you look closely at that massive pre-earnings volume, that 50 to 70 million shares, that is not just retail day traders on their lunch break.
No, definitely not.
That is aggressive institutional block buying. The smart money was accumulating shares heavily before the print, positioning themselves for a long-term profit margin turnaround rather than just trying to grab a quick short-term scalp.
So what does market sentiment look like? If we step back from the daily charts and look at the broader mood, the news headlines are very much stuck in a show-me phase.
Yeah, very cautious.
The media is hyper-focused on the negative cash burn, and they're letting that completely overshadow the fact that the company actually beat adjusted earnings per share estimates.
The Wall Street analysts are completely split on it too, which really shows you the uncertainty. You have H.C. Wainwright maintaining a strong buy rating with a $6 price target.
And then on the other side,
Right. On the other hand, Cantor Fitzgerald is sitting right on the fence at neutral with a $5 target. It perfectly reflects the ongoing tension between the newly improved, high-quality margins and the heavy historical baggage the company is still dragging along.
let's talk about the actual flow of money, because there's a glaring divergence here between company insiders and institutional funds. Recently, Director Pamela Joyce Braden sold 80,000 shares, cashing out about $320,000.
I know, that never looks good.
No, it doesn't. If you're looking at your portfolio right now, wondering if you should touch this stock, seeing a company director sell is an immediate flashing red flag.
Sure.
Add to that the fact that shareholders just approved doubling the authorized shares from 500 million to 1 billion. For a cautious investor, seeing an insider cash out, plus giving the company the legal permission to double the amount of shares in existence, absolutely screams danger. It feels like a blank check for future dilution.
I get exactly why that looks terrifying on the surface. But you have to weigh that insider sale against what the massive institutions are doing behind the scenes.
I mean, the smart money.
Yes. The smart money is buying this stock hand over fist. In the first quarter of 2026, Goldman Sachs raised its stake in the company by an astonishing 569%.
Wow.
Yeah, bringing their total up to 2.34 million shares. New Edge Advisors increased their position by 441%. Mirror Asset bumped theirs by 54%.
Those are massive, massive percentage jumps for conservative institutions.
Exactly. And there is an old saying on Wall Street, insiders sell for a million personal reasons. They're buying a new house, doing tax planning, paying for college, or just basic diversification. But institutions only buy for one single reason. They expect the price of the stock to go up.
That's a very fair point.
And as for that scary doubling of the authorized shares to 1 billion, let's reframe that completely. The company is sitting on $431.5 million in cash. They do not need to issue new shares just to keep the lights on or pay rent. That share authorization is not for desperate survival dilution. It's strategic preparation. They are arming themselves for a massive transformational M&A deal. They want the dry powder legally ready so they can acquire another highly strategic target the moment they see it, just like they successfully did with Ask Sage.
Now let's talk about the risks. We
Yep.
can't just brush past that word dilution without looking at the dark side of this trade. We always need to address the primary threats to the investment thesis head-on.
Absolutely.
The bear case here is firmly rooted in two major factors: cash burn and the threat of that dilution. We just spent time justifying that negative $18 million operating cash flow deficit. But even if you favorably frame those 1 billion authorized shares as an M&A war chest, it is still a permanent legal overhang on the stock. The threat that management might dilute your shares is always going to be sitting right there on the table.
It is absolutely an overhang, and investors need to be aware of it. But we have to pivot and look at what has fundamentally changed. The immediate, suffocating, company-killing dilution from those old 2029 convertible notes, that is entirely in the rearview mirror now.
They took the hit.
They ripped the Band-Aid off, they took the pain, and it's done. And that massive $500 million cash buffer entirely removes the going concern risk. A year ago, analysts were asking if this company would even survive. We weren't asking if they will survive the year anymore. We're asking how fast they can grow.
The second major risk, which we've touched on, is the incredibly lumpy nature of these government contracts. We saw their overall revenue dip 1% year over year, and we know that was entirely due to drops in Army program volumes.
Yeah, that lumpiness is real.
It is undeniable proof that federal delays, continuing resolutions, and government shutdowns are not just theoretical risks discussed on the news, they are structural business headwinds that actively hit this company's top line. If Washington gridlocks, this company's quarterly revenue suffers immediately. That is the worst-case scenario.
That is the harsh reality of operating in the defense sector.
Yeah.
But here is the ultimate safety net that helps offset that lumpiness, their massive backlog.
Right, the backlog.
They are currently sitting on a record $281.9 million backlog of signed contracts. That provides an unprecedented level of revenue visibility for them. They don't have to go out and fight to win $281 million of new business. They already won it. The ink is dry. Now it's just a matter of executing the work and sending the invoices.
So with everything on the table, what's the final verdict? We've looked at the impenetrable fortress moat, the massive cash pile, the insiders selling, the institutional buying, and the wild volatility of the stock chart.
Well, based on all the underlying research and weighing those risks against the structural turnaround, we are looking at a bullish score of 7 out of 10.
Okay, 7 out of 10.
Yeah. Here's the elevator pitch for you. BigBear.ai has successfully and painfully transformed its balance sheet. They wiped out 90% of their debt, which is an incredibly rare feat to accomplish without entirely destroying the company.
That is rare.
At the very same time, they are aggressively expanding their profit margins through the high-margin Ask Sage acquisition, proving they can operate as a true tech software platform.
So they have the tech and the cash.
Exactly. They are now fully armed with over $430 million in liquidity and backed by a $282 million contracted backlog. That specific combination of cash safety and guaranteed future work makes them uniquely positioned to capture the accelerating surge in national security AI spending over the next few years.
In terms of how to practically play it in your portfolio, the target horizon here is a medium-term hold strategy, looking at a 6 to 12-month window.
Right.
That specific time frame is designed to let you safely capture the expected unlocks of those delayed federal contracts hitting the balance sheet in the second half of 2026. It definitely requires a strong stomach and patience to navigate the high beta volatility, but the structural transformation is complete, and the new financial foundation is solid.
It really all comes back to that fortress plumbing analogy.
I love that analogy.
The messy, expensive work of tearing up the old concrete floors and paying off the old debts is finally done. Now they are deeply embedded behind the walls, the high-run data is flowing, and the massive institutions are quietly accumulating the building blocks while the rest of the market waits to see the proof.
Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply to the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.